Hello traders, and welcome to another episode. And in this episode, we are going to look at points of interest. And this will just be like an introduction to bring you into awareness of the points of interest that we look at when it comes to Forex trading. So what you need to understand, this content is basically for educational purpose because trading leverage product carries risks. Therefore, you need to have proper education before you start trading. So when we talk about the points of interest, why are these points of interest very important? So in Forex trading, points of interest are specific levels or areas on a price chart where traders anticipate significant market activities. So these are areas that traders look for the price maybe to come into those levels so that they can make a well-informed decision and identify high probability trades. So these points of interest, they are basically what you look at when, depending on the strategy that you're trading. So the key levels that you wait for the price to come into so that you can maybe trigger a buy entry or maybe a sell entry or maybe even an exit So what are these points of interest that we're talking about? So in this video, like I said, this is just to bring you into awareness of these points of interest. And in the subsequent episodes that I'm going to make, I'll be tackling each point of interest one at a time. Some of these points of interest, I've already done them. Like the candlesticks pattern, I already did the engulfing. I think that video was released this week. How to trade engulfing candlesticks patterns. I also did I'll also be doing a video on the Fibonacci. So you'll Fibonacci, the normal Fibonacci, and also the ICT Fibonacci, because those are also points of they are also used as points of interest, the Fibonacci retracement and extension levels. So when you're talking about these points of interest, the very basic points of interest that we know is the support and resistance. And support is basically a price level where an asset tends to find buying interest. So at the point of support, there is a lot of demand, right? So resistant level, this is where selling interest emerges. So at the resistant levels, there is a lot of supply. So how this support and resistance help traders is that in terms of decision making, traders will often look to buy at support and look to sell at resistance. All breakouts above resistance or below support can signal a new trend, and therefore traders can look for opportunities. Like for instance, if the price breaks above a resistance level, we look for buys because the resistance turns to be support. And when the price breaks below a support level, we look for sells because the support turns to be resistance, right? So for support and resistance, you can either trade the bounce or you can trade the breakout. However, I'll be breaking that into details, how exactly to look for your entries in the next episodes that I'll be doing. So when you talk about supply and demand, so supply and demand, basically, it's also another other types of points of interest that are really high probability. So supply zones are where sellers or where selling pressure has overwhelmed buying, therefore pushing the prices lower. So we look to sell at the point of supply. And demand zones are areas where buying pressure has outpaced selling, driving prices higher, and therefore we look to buy in demand zones. So when you're talking about demand and supply as key points of interest, how does it help you as a trader? So in terms of decision making, traders basically buy at demand and sell at supply zone, aligning their trades with the market forces. So these setups give you what we call high probability trades, because trading near these zones basically offers favorable risk to reward ratio, since the price tends to reverse strongly from these points of supply and demand. So the other key points of interest are the trend lines and channels. So trend lines are basically drawn along price peaks, that is in a downtrend. and maybe probably in troughs, that is in an uptrend, basically to define the overall market direction. So channels are basically parallel lines or parallel trend lines drawn to contain price action within a range. So like I said, today I'm just introducing this, and then in the next episodes, I'll be looking at each and every point of interest, how to take trades from those points of interest. So trend lines and channels will help traders in decision making, because traders will use these trend lines to follow the direction of the market. That is buying in uptrend trend lines and selling in downtrend trend lines. And also the breakout in these trend lines can indicate a reversal, and traders can position themselves accordingly depending on the direction of the breakout. So channels will provide clear entry and exit points, and traders can buy at the bottom of a channel and sell at the top of the channel. So basically identifying or giving you high probability trades. Then we have the Fibonacci retracement levels. So Fibonacci retracement levels, we have the 23.6%, the 38.2%, the 50%, the 61%. Just like we discussed in the Fibonacci video, the normal Fibonacci and also the ICT Fibonacci. So in these retracement levels, they represent areas where prices is likely to retrace during a trend. And in that video, maybe you can go and rewatch the Fibonacci videos, because I talked about an additional bonus that you need to look at when you're using the Fibonacci retracement level. Not only are you looking at the levels, but there is a bonus point that I gave there. So please make sure that you watch that video, and you'll be able to understand the Fibonacci well. So I've already done the Fibonacci. I believe there is no problem with the Fibonacci. So it should be well understood by now. But in summation, Fibonacci, traders use these retracement levels to identify key levels where corrections might end, providing potential entries. So when price retraces to a Fibonacci level and bounces, it increases the likelihood of the trend continuing, offering a favorable, or what I call a high probability entry. Then we have the moving averages, and for me, I prefer using the 50, 10, and 200 periods combined together. So these moving averages, their work is to smooth out the price data to show the overall direction of a trend. So in terms of decision making, moving averages will help traders to identify the trend direction and potential points of support or resistance, because if you're using like the 200 moving average, this 200 moving average acts as support and resistance. So anytime price is above the 200 moving averages, you're in an uptrend. Anytime the price is below the 200 moving average, it's in a downtrend. And when the price comes to retest that moving average, you can really get an entry. And when we have a breakout above that moving average or below, you can still get high probability entries. So the reason why we are saying that crossover of short-term and long-term moving average signal signals potential buy or sells opportunity. All right, so that is what we call golden cross for bullish. We have also death cross for bearish, but I'll be talking more about that in a subsequent, the next episode that I'll be doing, basically on how you can use the moving averages to enhance your trading success. Then we have the pivot points, and pivot points are calculated levels based on the previous day's high, lows, and close price, used by traders to predict potential supports and resistance levels. So this one will help you as a trader, basically in terms of identifying intraday levels for entry, stop loss placement, and profit targets. So high probability, in terms of getting high probability trades, these pivot points, especially the central pivot points, are often very reliable indicators for price reversals, offering opportunities for profitable trades. Then we have the chart patterns, and chart patterns, my favorite are the bullish and bearish rectangle, double top and the double bottoms. They form very nice entries. I'm going to discuss about them in the future videos that I'm going to create. And when you're using the chart patterns, these chart patterns, they can either be reversal chart patterns or they can be continuation chart patterns. So they indicate shift in market sentiments, allowing traders to participate in the next market move. So recognizing patterns before they complete forming will help you as a trader to enter trades early and with strong confirmation, improving accuracy. So then we have the candlesticks patterns, the likes of doji, engulfing, pin bars, which provide insightful information into the market sentiments and potential price reversals. So these candlesticks patterns, we have the rejection candlesticks that show reversal. We have the continuation candlesticks. I've already done a video on how to identify high probability entries using the engulfing patterns. So you can rewatch that video. I'll also do some more videos on candlesticks patterns, basically the dojis and the engulfing and the pin bars, how you can use them to identify rejection of prices or reversals. So traders will use candlesticks patterns to time entries and exits, especially in conjunction with other points of interest like support and resistance, because you have to combine them. These patterns are highly reliable when they form at critical levels, increasing the likelihood of successful trades. So like the video I did about the engulfing candlesticks, you can just revisit it. I showed clearly how you can use the engulfing, taking trades at key points of interest, like maybe support and resistance, basically to try and improve the confluence. Confluence is whereby you have more than one confirmation why you should buy or sell, which increases the probability of that trade. Then we have the other points of interest. Basically, when you come to ICT, we have the order blocks, we have the breaker blocks, we have the mitigation blocks, we have the rejection blocks, the fair value gap, liquidity void. We have the liquidities themselves. So under the liquidities here, we are talking about the buy side liquidities and the sell side liquidities. And also we have the gaps. So these are ICT concepts that have been authored by ICT, the author of ICT, the owner of ICT. And I shall also be taking time going through each and every point of interest here, one at a time, basically trying to simplify it for you so that you can be able to understand how we are able to take trades from these points of interest. So in a nutshell, what will happen in the subsequent videos that I'm going to be making, I'll be taking each and every point of interest and discussing it into details so that you can be able to be in a position to understand how you take trades using any of the points of interest. But what I would advise you as a beginner, if you're in the beginner's level, the key thing is to choose like one point of interest and perfect on that point of interest. Remember, you cannot become a master of everything, but you can become a master of one, right? You can become a master of one. So because I've seen a lot of traders wasting time trying to study all to perfect different strategies altogether, and they end up wasting a lot of time. So today they will hear about order blocks, so they want to learn about order blocks. Tomorrow they will hear about maybe candlesticks patterns. They will want to rush and start reading about candlesticks patterns. What will happen is that you'll meander. You'll be meandering a lot without making any substantial move. So the best thing, if you're a beginner, yes, you can try all of them while you are journaling your trades, so that now you can, like maybe after 1 month, you're able to see which these points of interest are best for you, which ones give you best entries, more profits, and therefore now you can specialize in that particular point of interest. Like for instance, when it comes to ICT, most of the people tend to get confused when Michael teaches, because Michael is the author of ICT. When he teaches, most of the people tend not to understand, because within that ICT, there are so many ways you can be able to take trades. You can use either the ICT Fibonacci, you can use the order blocks, you can use the breaker block, you can use the fair value gaps. name them all these ICT. So instead of loitering all around, take one. If you want to master the order blocks, perfect on that first and become a master of the order blocks before now you start looking at the fair value gaps, before you start looking at the mitigation blocks, right? So that's it. And ensure you keep in touch because it's gonna be interesting. Like I said, I'll be uploading videos, or I'll be doing more modules or more series in terms of all these points of interest until we exhaust them all, so that at least you can have some idea, or so that at least you can be able to improve your trading. So thank you very much, and see you in the next video.